This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus and Dianne Crocker. For the week ending August 1st, investors have a full roster of economic and earnings data to sift through, as well as another Fed decision, which left the Fed funds rate unchanged, but precedes inflation and jobs reports that will be important as we set the stage for any expectations of a cut in September. Manus, there really wasn't any surprise on Powell's continued cautious tone, but we did see dissenters in the committee for the first time since 1993.
The Fed surprised no one this week with holding rates steady. There were a few outliers that thought maybe the Fed would cut, and we did see those two dissents that you referred to, but the expectations were high that the Fed would remain vigilant against the threat of tariff-related inflation, and the markets reacted accordingly, which was a big yawn. I do think that at some point this year we will see a Fed rate cut or two, perhaps in September, but for now the Fed has really held steady. They've decided that the risks of inflation coming from tariffs is real, and they're not going to be bullied, perhaps that's the right word, into slashing rates just because the president is leaning on them. But it was a very, very busy week for economic news in general. We've been saying this for quite some time that, and we talked about it with Rebecca last week, that at some point this collection of tariffs has to have some kind of impact somewhere. We know that the receipts by the Treasury are meaningful. They're on pace to collect between $100 billion and $200 billion this year, and somebody has to be paying that. It has to be either absorbed by companies who are not passing it on to consumers, or it has to show up in the inflation rate, or some combination of the two. And thus far, we've seen very little evidence of either, which has been shocking. And it's led me to say that at some point in the second half of the year, we're going to see some bumpiness in equities because the piper has to be paid at some point. But we saw the first indication of this, I think, yesterday with the Ford earnings, with Ford coming out and saying they were going to have close to $1 billion hit from tariffs this year. It wiped away a big chunk of their year-over-year earnings. And that may be the canary in the coal mine, the first company of many that will come out and say, yes, these are taking a bite out of our earnings. And that's why I underscore the point I made a moment ago. I do think that at some point in the second half of the year, we do see some choppiness in the markets.
Yeah, Manus, I want to go back to something you said about the Fed meeting this week. Am I the only one getting deja vu on the interest rate front? Because I feel like 2025 is starting to feel a lot like last year, just in the sense that we're now 5 Fed meetings in, no cuts, just like last year. Once again, all eyes are on September for that long-awaited drop. And of course, the backdrop's different this year. We have federal policy shifts, tariffs are new variables that we didn't have last year, but the rate trajectory just feels eerily familiar. I think that the current likelihood is around 50% that we'll see a rate cut in September. I don't think it'll be 50 basis points. I think if it happens, it'll be 25. But Ryan Severino, who has been a guest on our podcast, just came out with his weekly commentary, and he noted what you just said, which is the Fed is caught between a rock and a hard place with its dual mandate because inflation has slowed down considerably over 3 years. But as Rebecca said last week in the podcast, there is a widespread expectation that inflation will start to reaccelerate, and simultaneously the labor market, along with the overall economy, is starting to slow down. So the Fed's in a tough spot. And the other thing that Rebecca brought to the surface that really kind of stuck with me is that the thing that she's watching is the labor market. She said, the labor market's king. So watch what's happening with things like job growth, with what employers are saying about their intentions around labor. And her reasoning was that ultimately it's the consumers that are sitting in the driver's seat. And if they don't spend, then that starts to ripple through the rest of the economy. And if they don't have a job, they're going to curtail their spending. So her perception was that the labor market's kind of like a light switch. And if it starts to dim, it gives us an early read into where things might be headed. So I am taking notice of a lot of July headlines about layoffs. It's not a surge, but it's something to keep an eye on. Merck and company announced in their Q2 report that they have immediate layoffs in July. Moderna is cutting 10% of its global workforce. Microsoft in early July announced that they're laying off 9,000 employees. Intel's layoffs exceed 5,000 across the US. So it's definitely starting to happen. And to Rebecca's point, it's important to keep an eye on what's happening in the labor market.
It's certainly an important metric, and we'll get a number on the July jobs report soon that will be indicative to some degree of where we're headed. But let me say, I'm kind of spitballing here a little bit, talking off the top of my head, but I think that both sides have this wrong, honestly. I think they're both dug in, and I think they're both dug in incorrectly. And let me see if I can explain this. It's really just dawning on me now. Let's take the president on one side. I've said before, I don't think the bullying is helpful. I think it's incredibly unconstructive. So let's leave that there. But beyond that, the idea that we should be 3 percentage points lower than where we are today, that we should have a 1% Fed funds rate is absurd, right? That would just trigger a new wave of bubble like we saw in 2022. Nobody needs that. On the other hand, I do think that the Fed, in not cutting rates, is also dug in, but for all the wrong reasons. And let me see if this makes sense. Normally, in trying to cool off the U.S. economy, it's done because people have too much cash in their pocket or because the economy is overheating. That's why the Fed is called upon to raise interest rates, to taper down the acceleration and the velocity of the economy. But if you say that inflation is coming from tariffs or will be coming from tariffs, then it's coming from taking money out of people's pockets. That's not an accelerator, that's a decelerator. And if your thesis is that we're going to see 10% higher costs of electronics, durable goods, clothing, and so forth, that is a tax. And if that's the case, the Fed has no reason not to cut. This is not an overheating economy. This will be an economy that is taxed. And accordingly, the Fed should cut periodically to make sure that we don't run into a brick wall because of tariffs. I think they have this all wrong right now.
That's why I nominate you, Manus, for the next Fed chair position when it opens up in May or earlier.
I'm not sure I could stand up to the slings and arrows that I see on social media or coming from the talking heads on Bloomberg and CNBC and Fox Business. I don't know. I don't think I have that kind of constitution.
Well, a couple points that I want to highlight here that I think underscore some of the things you're talking about, Manus and Dianne. We see a number of earnings calls that are highlighting some of the impact of tariffs already. Last week, it was GM that had more than $1 billion chunk taken out of its profits as a result of tariffs. We have seen UPS, Whirlpool, Stanley Black & Decker, P&G all report weak quarterly results, all impacted by tariffs. And, we talk about the consumer health. There are signs that the consumer is dealing with financial stress. More homeowners are tapping their home equity in the last year, and they're doing it for debt consolidation, not necessarily for home improvement projects, which have fallen off since the height of 2022. And more upper income Americans are increasingly falling behind on their credit card and auto loan payments.
I think that dovetails with what I was just saying. There's no reason for the Fed not to post some modest cuts between now and the end of the year. I think perhaps stubbornness is taking over reason at this point, but the tariff effect is starting to show up, as you pointed out. It will continue to show up, and that will tax both the consumer and U.S. businesses, and accordingly, the Fed should not be hawkish at this point. They don't have to be dovish, but they could be more accommodative than they've been over the last couple of months. And I do think, I use this term frequently, whistling past graveyards. I do think that we have gone from complete panic in April to we're not just whistling past graveyards. This is a chorus of kazoos right now. We are seeing two companies now with $4 trillion market caps. We are seeing the S&P 500 trade at near all-time PE ratios at a time when we are expecting rates to go up, or I should say inflation to go up, and the U.S. economy to slow. This is a recipe for people to have real buyer's remorse if they're buying into this FOMO thought right now that if I don't get it now, I'm going to miss out on the next wave of stock market gains. That's my 2 cents. I'm not really a stock market predictor, but the market seems very, very frothy right now.
And all of this is a backdrop to investment sentiment for commercial real estate. And we decided that we needed to take the pulse of those that are market participants. So, Dianne, walk us through some of the findings of our mid-year market sentiment survey.
Yeah, let's talk sentiment. So we are just closing out the LightBox Midyear CRE sentiment survey, which closed a week ago Friday. It also coincided with CREFC's Q2 sentiment index, and they both paint kind of a consistent picture and not that far away from what you just talked about, Manus. You know, the market's far from booming, but the soft data on sentiment is pointing to a market that's stabilizing, that's adjusting to widespread uncertainty, and even showing flickers of optimism as we go deeper into the second half. So first of all, Martha, I wanted to thank the 237 professionals across brokerage, investment, lending, appraisal, and environmental due diligence who took our survey. From the results, you know, I'd say it's kind of a classic case of muddling in the middle. You know, we asked them about their expectations for the second half, and nearly 3/4 of the survey sample expect their deal activity to either hold steady or increase slightly. I didn't see a lot at either end. No one's extremely bullish, no one's extremely bearish. And I think that's because uncertainty is the backdrop. The industry is not blind to that, and it's not going away anytime soon, but they're pushing forward. And those findings dovetail with CREFC's sentiment index, which jumped nearly 28% in Q2. And what struck me about that is I remember when CREFC's Q1 survey came out, their index fell dramatically from a high in Q4. And in Q1, it went below 100. And that was the first time since COVID that it did. And now they're reporting that their members who are on the CRE lending side, only 27% expect conditions to worsen in the next quarter. So that's a huge improvement over 80% that were expecting worsening conditions when they surveyed them after Q1. So, you know, we're seeing both the LightBox sentiment survey and the CREFC data move in the same direction. So it's giving me more confidence that we're on this kind of slow and steady shift in sentiment after the unrest that followed the tariff announcements in early April. So the market's kind of lying in wait for that first interest rate cut. They're waiting for policy clarity. They're waiting for more certainty to come out in terms of how tariffs will impact the market. But the overall expectation that we see is for higher CRE investment and lending activity in the second half compared to what we saw in the first.
I think the sentiment matches the data that we're seeing. And I think it's one of the most remarkable aspects of the first 7 months of 2025, that we saw no meaningful downdraft in economic activity for CRE after April 2nd. We saw that huge swoon in stocks, 20% dip in the major indices right after the tariffs were announced. That never really coincided with a slowdown in CRE transactions. So April, May, June, very, very consistent numbers in what we track in terms of announced sales per week. Really nothing deviating from the norm during those. But I will point out, and this is a bullish sign, that over the last 2 weeks, we have seen a meaningful uptick in the number of announced transactions we've seen weekly. So what is meaningful? We bounce around at about 200 transactions a week, give or take give or take 25 week over week from the data that we see. The last couple of weeks have seen a 30 and 35% uptick from our average. And when you consider this is the last 2 weeks of July, when we normally don't see a lot of transactions taking place, this is a remarkable number for me. People are just getting deals done. People are putting risk on. Lenders are lending. And the CRE market has just not missed a beat thus far. And whereas I am modestly bearish on equities, only because of valuations and because of the impact on profits, I remain bullish on CRE because I think people are confident right now. People are putting shovels in the ground. They are buying properties to reposition. They are expanding their portfolios. The buyer pool is deep, and all four pillars of the lending community, CMBS, banks, insurance companies, and non-banks, are lending full steam ahead right now, and it feels good.
It does feel good. I'll also say, Manus, that since we're at the end of July, that means that we'll have our monthly CRE activity index next week. June's was the highest of the year, so we'll have to see if July's is as heated as the temps have been this week. But based on the transaction data that you just mentioned, I think there's a pretty good chance that we'll be at June's levels, if not even higher.
Well, I think I'm on record as saying we would be 25 points higher on the index between June of 2025 and December of 2025. I stick with that. We made some big progress last month in that 25-point uptick. I think we're going to see some gains in July too. I think this will be a pretty good month for the index. I haven't seen any numbers yet, so I'm not foreshadowing this yet, but it's a prediction. And I do feel pretty good about the rest of the year for CRE.
And we also are about to release our quarterly market snapshot report for environmental due diligence. And it's an early indicator of sales transaction activity looking at due diligence reports. Dianne, what did it show?
It is. Yep. Next up in our snapshot series is our check-in on the phase one ESA sector. And environmental site assessments are the essential step, but they typically happen at the end of the underwriting process. So there's some good news in the Q2 report, and that is that activity picked up solidly in Q2. So the LightBox Phase 1 ESA Activity Index rose to 96.9 in Q2. That was 13% higher than this time last year. It was 12% above Q1. So in my mind, that's a strong signal that deals are making it to the finish line more consistently than they were 1 year ago. And then looking ahead to Q3, the mood is relatively upbeat, similar to what you just said, Manus. We have 12 new market council members that we queried at the close of Q2. None of them are expecting a decline in Q3. 44% expect a modest uptick in activity. And I'll note that historically, the third quarter, especially September, when we all come back from our summer vacations, it's typically a ramp up to increased transactions that will close in the fourth quarter. So we're already hearing from consultants whose clients are expecting more projects to surface at the end of Q3. And we'll see that especially if we see a rate drop in September. So the phase one snapshot report drops next week. So if you want a deeper dive, definitely stay tuned for that. And I want to pause here, Martha, also, and give a shout out to Sarah Feit at AEI Consultants. She is a loyal listener, and she mentioned the episode with David Poutreau at Morningstar. She said that she had to listen to it twice because there was so much data to absorb. So thank you, Sarah, for that.
Turning this from a numbers thing to a personal thing, so many of the people we know in the industry struggled in 2023 and 24. Brokers, environmental professionals, engineers, appraisers. Business was down, and that hurts. When you're not seeing the activity that you see in prior years, it means you're tightening your belt, you're trying to do more with less. And it's just wonderful to see our friends now seeing the other side of that mountain right now and seeing businesses, activity picking up, getting back to those normal days of 2018, 19, and 20, where you could expect consistency month over month. So just on a very personal note, this is very satisfying.
And our Did You Know takes us back to our environmental data.
It is. So nationwide, the total volume of phase one reports hit nearly 70,000. in Q2, and that was an 11% year-over-year increase. And if it continues, Manus, this is good news for the environmental consultants who have struggled over the past couple of years. If the trend continues, that means that 2025 could be the second consecutive year of growth after 3 years of a downturn. So that would also be good news.
Before we get to the transactions, Martha, I have to give a shout out to our friend Matthew Osborne. He was a guest to the pod, longtime listener, friend. He knows the Boston market inside and out. He goes by the nickname Oz, and our condolences to him. He went into music, which is his real passion in life, after having listened to Ozzy Osbourne. Our listeners probably know at this point, the great Oz passed away. Ozzy Osbourne passed away last week at the age of 76. And Matthew Osborne wanted us to give a shout out on behalf of the founder of Black Sabbath and a real innovator when it comes to heavy metal, right? One of the real trailblazers of that genre of music. So that's for you, Matthew Osborne.
Who, by the way, is no relation to the Ozzy Osbourne.
Martha, it was a tough week for boomers, right? We lost one of the Cosby kids. We lost Hulk Hogan, Ozzy Osbourne, and Chuck Mangione. Not exactly a week for the average boomer like me.
They do come in waves. And shifting over to some noteworthy transactions, let's start with some multifamily mixed-use transactions.
There were plenty of them, as there seem to be every single month. Multifamily is really the bellwether, if you will, in commercial real estate. It makes up the vast plurality of transactions that get done week over week or month over month. And we saw some big ones as we normally do. One of the big ones last week was JP Morgan acquiring a big, we'll call it mixed use, but it's primarily multifamily project on Manhattan's Midtown West. This is really close to the West Side Highway. They paid $243 million for that property, which includes some street-level retail. It just goes to show that the velocity in multifamily sales continues, and people are willing to really pay high prices for Class A minus properties really throughout the country.
It's also a big sign, Manus, that JP Morgan's deepening its footprint in multifamily. It follows its recent acquisition in Atlanta, and now its in-house rental portfolio is closer to $2 billion. So it's a lot of confidence in multifamily, and they're definitely pushing forward to expand their footprint there.
I'll highlight two other multifamily notes here. This is kind of more in the development side than it is transactions, but I thought that these were important ones, and I apologize for being so New York-centric in my stories today, but these all jumped out at me. JLL arranged a $123 million construction financing for a Brooklyn multifamily project. Why did that jump out at me? For the reason I really talk about every week, and that is the first things to fall by the wayside when cracks start to come in the market are the ability to find construction financing and the ability to find financing for conversion projects, offices to multifamily, offices to hotel, et cetera. We are seeing really no downdraft at all in the amount of money available for people who want to put shovels in the ground. Here, a $123 million loan for a Brooklyn apartment project. Also in New York, the Lightstone Group finalized the sale of 355 Exterior Street in the South Bronx. This comes after the buyer secured a $300 million construction loan. Bytel Group was the purchaser of the development site. They're planning 2 residential towers, and that will replace a bus depot and an empty lot. They acquired those sites for $84 million. And this is like the JLL story. Nobody puts up $84 million unless they know that they're going to find construction financing, unless they know that they can develop a project successfully. And here what you're seeing is one of the few really neglected areas of New York City until the last couple of years, the South Bronx, getting a lot of money to see that get built up. For a long time, the South Bronx was really a wasteland. not even industrial would develop in the South Bronx. It was really just extremely old multifamily or empty lots. And what we've seen, I think it was started with RXR, is a renaissance in the South Bronx with large 20 and 30 and 40-story apartment buildings going up just over the edge of Manhattan, right at the southernmost point of the Bronx. And this is another one here. Lightstone lending, Bytel buying, and putting up more high-end housing in the South Bronx. Is there a more significant sign of confidence in this market than that?
Agreed, Manus. And I just wanted to mention that in the South Bronx project, it's a mix of affordable units. So 25% of them will be affordable units. So they're looking definitely to appeal to a broader demographic in a borough that's really grappling with housing access and cost pressures. And I think those stories that you mentioned really demonstrate that there's been this resurgence of institutional capital flowing into urban housing assets, even amid the macroeconomic uncertainty that we've been talking about, and certainly demand for housing options outside of Manhattan, which a lot of people can no longer afford.
I love the affordable housing angle. I love the fact that a big chunk of this will be set aside from that. And for New York expats, people that haven't been back to New York, I think you'd be blown away by just how much development there has gone into that area. You get on that Metro North commuter railroad and you go from Westchester to Grand Central Station, the amount of development in the South Bronx is really extraordinary. It's a great sign of a revitalization of a really beaten down neighborhood.
Shifting into office, we saw a report coming out of Commercial Mortgage Alert that office sales have soared by 40% in the first half, which is very upbeat for those of us that are watching the office market closely.
The office sale velocity has been really extraordinary. People can complain about the fact that prices that they're seeing are miserable, and they are. We are seeing 50, 60, 70% discounts on sales. So the losses are meaningful and they're very, very painful for those that bought in, let's say, 2012 to 2020. Those losses are really big. But nobody can really complain about transparency of data. There is so much buying and selling of office right now that really in any major U.S. city, you can see a boatload of comps really across the class spectrum. So at least in that regard, people know what things are buying and selling for. You know what the price per square foot is in San Francisco and Chicago and New York for Class A, Class B, Class C. And at least that will help this market clear sooner. And by clear, we mean find its bottom, start to restore value, start to see prices firm up a little bit. They won't firm up anywhere near where they were in 2019, that's for sure, at least not for anything that's not completely Class A trophy. But we will see this market clear and continue to stabilize. But a couple of office stories I'll point out to get away from my New York centricity. Bradford Commercial Real Estate acquired a 250,000 square foot office in Uptown Dallas. The article, I think it's Commercial Observer, just points out that there's continued investor appetite for urban office locations in major Sunbelt cities. And this kind of talks about or talks to the fact that there is really a tale of two markets in office right now. If you have a great location and a highly amenitized building, and if you can complete the hat trick by it being really new, right, built in the last 2 or 3 years, you will get premium rents, you will get premium valuations. This is really true across the country. There is no crisis in the Class AAA, newly built, highly amenitized office market. It's everything below that that is in a complete crisis. And that's true in Dallas, it's true in San Francisco, it's true in New York. Going to San Francisco, our other sale here, Redco will acquire Wells Fargo's San Francisco headquarters at 420 Montgomery Street. There had been a previous deal for housing there that fell apart. Redco is now stepping in to buy the building. The story behind it is Wells Fargo was the dominant tenant at that property for a long time. They announced a couple of years ago that they would be exiting this 400,000 square foot complex and relocating to 333 Market Street. They were also going to consolidate a large number of other local offices in San Francisco. So this is another example of somebody coming in, buying at a dirt cheap price, hoping to refurbish the office and restore value. And that's happening across the country, albeit at just really, really low prices.
It's interesting, Manus. The office sector just strikes me as kind of like a big flywheel. A few years ago, nobody was moving. There was no price clarity. And now with every story like the ones you just highlighted, it just signals that the thaw is on and investors maybe are getting a little bit of a sense of FOMO that they better move in now or miss out on deals. And you can't underestimate the impact that price clarity is having on this sector. With every transaction, it makes it easier to do valuations. It makes it easier to close the gap between bid and ask prices that really kind of thwarted transactions in the past few years. So it's really great to see that momentum's building and brokers are busy again, that capital markets are slowly opening up. I agree with what you said about Dallas. I think that always rises to the top when we look at metros that are attracting the highest demand for things like environmental due diligence and appraisals. And then last, I thought it was interesting with Wells Fargo that, they made the decision to leave that property, but they're staying within the same submarket. So it reinforces that while their space needs are shrinking, San Francisco remains central to their operations.
I'm going to come up with an imperfect comparison here to contrast two really down markets over our lifetime. The first is when we went through the great financial crisis, we saw AAA rated bonds, and in particular, I'm talking about AAA rated, what are known as junior AAAs or mezz AAAs. So these were kind of the second level of AAA within the CMBS market. And when that market tanked, we saw things selling for 15 cents on the dollar, 20 cents on the dollar, 30 cents on the dollar. And when that market started to clear, there was really only one buyer, and that was Appaloosa. They came in and started acquiring these assets for those extraordinarily deep discounts. And many of these bonds paid off at par. They ended up posting incredible profits for making this bet back in 2010, 2011. The difference now, the discounts are similar for office. We are seeing sometimes 85% discounts, 80%, 75%. The difference now is the buyer pool is quite deep. When we see 30 or 40 office transactions in a given month, it's rare to see a repeat buyer. This is not the Appaloosa story where there was only one buyer. There's a lot of buyers dipping their toes right now, trying to make this bet that they can turn a $50 million investment back into a $100 million value. At the risk of repeating myself, this is just another sign of a confident market, that there's so many people out there making this bet right now.
We've seen tech earnings this week, and they are not stopping on their AI investments. And we've been talking week after week about the investment in data centers. Well, apparently, the development of data centers is starting to monopolize construction resources.
The headline from Commercial Observer was labor costs, water and power needs, timelines. The asset du jour is starting to strain building development across the board. I've been very upbeat in office. I've been upbeat on market velocity so far. This does concern me, this headline, that when you talk about how much financing is going into data centers right now, you ask, will that crowd out, or will that pause, or will that push up the cost of financing on other less sexy investments right now? Are we going to overemphasize that at the expense of something else? Will these power needs drive up the costs of others in areas where data centers are being built? Will it drive up the costs of multifamily operators or retail operators? For those that are putting shovels in the ground, will it be harder to find labor because so many data centers are being put up? All those are good questions. And we have a lot of tailwinds right now for CRE. This could be a headwind. What do you think, Dianne?
I think you might be right. I mean, there's definitely cause for concern. Imagine penciling out a data center project and trying to incorporate what tariffs could mean on things like steel and electrical components, which are they'll push data center project budgets even higher. And, to your point, these shocks could make financing and timing not just challenging on data centers, but challenging on other projects who may also see a related increase in costs, harder time finding labor for construction if everything is gravitating toward data centers. And I wonder too, bigger picture, like where's the end point? Everybody's scrambling for data centers. They're, as you said, the sexiest sector of commercial real estate, but is it sustainable? How long can this go on? I don't disagree that there will be ripple effects, certainly, or possibly in other sectors like industrial and office and multifamily that may, in response, face longer timelines, face higher costs, and constrained access to skilled labor, which is already constrained.
Two thoughts on that. My first is, of the three things that the Commercial Observer article pointed out, labor, financing, power generation, it's the third that concerns me the most. When you talk about how much power they are anticipating using, that they were going to unmothball nuclear power plants, that tells me buckle up if you are a renter, buckle up if you're a multifamily operator, buckle up if you're a homeowner, that if you live in one of these areas where a data center is coming, you are looking at severely higher energy costs down the road. Could I be wrong? Certainly. I hope I'm wrong. Maybe these developers create their own energy sources. They create new nuclear power plants that run their own data centers and so forth. But something tells me that this is going to have a long tail, and it's not going to be a happy tail for people that live in those neighborhoods. The other thing I would say, which is a little bit off the beaten path, I was saying at the very top of the hour that I am a little bit concerned about equities being overvalued. Part of my thesis there, in addition to the fact that PE ratios are just so high right now, is that the numbers being bandied about by Google, Meta, Microsoft, and others in their AI spend is so enormous that someday this has to tweak their earnings, right? They are talking tens, if not hundreds of billions of dollars in AI investment. And at that kind of level, at some point you would think that investors would say, well, future growth will have to come at the expense of all this CapEx, right? At least in the short term. We'll see.
We would be remiss if we didn't talk about the event that obviously has gotten everyone focused on the absolute tragedy we witnessed in Midtown Manhattan with the shooting of a number of people, including those in the real estate world. And it's raised the topic of office safety in addition to just being an outright senseless tragedy.
I want to just mention, Martha, the loss of Wesley LePatner. She was one of the top-ranking female executives at Blackstone. She was the CEO of BREIT, which is Blackstone's $53 billion real estate fund for retail investors. It's a tragic loss, not just for the firm, but for the broader CRE community, because beyond her leadership role, she was such a powerful advocate for diversity. She was a true champion for women in commercial real estate, and she really paved the way for others in the industry through mentorship by her example. So her loss is felt not just by her colleagues at Blackstone, but across our industry. So our thoughts are with everybody who's mourning the loss of Wesley, as well as the three other victims. And like Martha said, it's also raised the topic of office safety and put the spotlight on security measures.
By all accounts, Wesley was a wonderful person, a great leader. We're seeing all the tributes pour out, and she just seemed, to your point, Dianne, to be such a great human being. For those that are not fully engaged in the CRE markets, not only are we talking about a wonderful human being, we're talking about somebody who was at the absolute top of their profession. Blackstone, one of the truly great companies in the commercial real estate space, and to be the CEO of their flagship operation puts you at the very top of the CRE profession. And our thoughts just go out to her family, her coworkers, Blackstone in general, and everybody in New York who was touched by this senseless tragedy.
Our thoughts are with all the victims and their families. And as always, thank you for listening, and be well.